What if I told you that over $780 billion is invested using just 3 funds? Not 300 funds, not 30 funds, just 3. While everyone else is frantically checking their portfolio 20 times a day, analyzing 50 different companies, trying to time the market, and losing sleep over whether they should buy the dip or sell the rip, some of the most successful long-term investors are doing something radically different. They're using a strategy so simple that it sounds almost too good to be true. Here's the problem with investing today. The average investor has between 20 and 30 different holdings in their portfolio. They're paying over 1% in fees every single year. They're constantly second-guessing their decisions, moving money around. And frankly, most of them are getting crushed by a simple index fund. And here's the really wild part. Studies show that the more choices investors have, the worse they actually perform. It's called analysis paralysis, and it's costing people millions in potential returns. But today, I'm breaking down the strategy that legendary investor Jack Bogle used to revolutionize the entire investing world. Just 3 funds, access to over 22,000 global securities, less than $40 per year in fees on a $100,000 portfolio. And in 2025, this strategy is absolutely crushing it with returns that are going to blow your mind. By the end of this video, you're going to understand exactly how to build a portfolio that requires almost zero maintenance, costs next to nothing, and has been proven to outperform most professional money managers over the long term. Let's dive in. To understand why this works, we need to talk about a man named Jack Bogle. Back in the 1970s, Bogle had a radical idea that went against everything Wall Street believed. He said, "Look, if you can't beat the market consistently, why not just own the entire market?" Wall Street hated this idea because, well, how are they going to charge you massive fees if you're just buying everything? But Bogle didn't care. He founded Vanguard and created the first index fund available to regular investors. It was revolutionary, and Wall Street thought he was crazy. Fast forward to today, and communities like the Bogle heads have decades of data proving that this simple approach works. In fact, Warren Buffett was so confident in index investing that he made a famous bet with hedge funds. $1 million on the line. His simple index fund versus 5 hedge funds picked by professional investors. The result? The index fund absolutely destroyed the hedge funds. It wasn't even close. While the hedge funds were charging 2% management fees plus 20% of profits, the index fund quietly delivered 13.9% annualized returns over the past decade with minimal fees. Here's what really gets me excited about this approach. It's not just about the returns, although those are fantastic. It's about reclaiming your life. Think about how much mental energy you spend worrying about your investments. Checking prices, reading news, wondering if you should sell, wondering if you should buy more. The 3-fund portfolio eliminates all of that noise. You set it up once, contribute regularly, rebalance once a year, and that's it. You get your evenings and weekends back. You stop losing sleep over market volatility. And ironically, by doing less, you actually end up making more money than most active investors. So what are these 3 magical funds that make this all possible? Let me break them down for you. Fund number 1, VTI. First up, we have VTI, the Vanguard Total Stock Market ETF. This is your US market powerhouse, and when I say powerhouse, I mean it. This fund has $542 billion in assets. That's not a typo. $500 billion. This thing is absolutely massive, and there's a very good reason why. VTI gives you exposure to the entire US stock market in a single ticker symbol. We're talking 3,526 companies, from tech giants like Apple and Microsoft all the way down to small regional banks and local manufacturers you've never heard of. Every publicly traded US company of significant size is in here. Now let's talk about 2025 performance, because this is where it gets really interesting. As of September, VTI is up 13.63% year to date. The current price is $327.18 per share. While the financial media was creating panic and telling everyone the sky was falling, VTI quietly delivered double-digit returns. And this isn't a fluke. Over the past decade, this fund has generated an annualized return of 13.9%. Let that sink in for a second. Almost 14% per year. Every year for 10 years straight. But here's what you're actually buying when you own VTI. The fund is heavily weighted toward technology at 31.3% of the portfolio. That makes sense because tech companies are the largest businesses in America right now. Then you've got financials at 14.3%, consumer discretionary at 10.6%, industrials at 9.9%, healthcare at 9.5%, and communication services at 9.3%. The rest is spread across every other sector you can imagine. This isn't just a bet on big tech. This is ownership in the entire American economy. From the companies making your phone to the ones building roads, from the banks processing your payments to the manufacturers building electric vehicles. Now here's where the three-fund portfolio really starts to shine. The expense ratio on VTI is just 0.03%. Do the math on that. For every $10,000 you invest, you're paying just $3 per year in fees. Compare that to the typical actively managed mutual fund that charges 1% or more. That's over $100 on $10,000, and it adds up to tens of thousands of dollars over a lifetime. VTI also pays dividends of $3.75 annually, distributed quarterly, giving you a dividend yield of 1.15%. And here's the cherry on top. VTI has a turnover rate of just 2%. That means the fund is barely trading stocks, which means minimal taxable events, which means you're keeping more of your money instead of handing it to the IRS. You're not just buying stocks with VTI, you're buying every innovation, every breakthrough, every success story in American business. And you're doing it for less than the cost of a fancy coffee per month. Fund number 2, VXUS Now. If VTI is your foundation in U.S. stocks, VXUS is your expansion into the rest of the world. This is the Vanguard Total International Stock ETF, and this fund is the comeback story of 2025. VXUS holds $106 billion in assets and gives you exposure to 8,653 international stocks across more than 50 countries. We're talking about companies in developed markets like Japan, the UK, and France, plus emerging markets like China, India, and Brazil. This is true global diversification. But here's where the story gets absolutely wild, and this is the part you need to pay attention to, because it perfectly illustrates why you need international exposure. For years, international stocks lagged behind US stocks. People were saying, you don't need international diversification anymore. Just buy American companies. Some investors completely abandoned international stocks. And then 2025 happened. As of September, VXUS is up 25.34% year to date. Let me repeat that. 25.34%. That's nearly double the return of VTI, which itself had a great year at 13.63%. This is not just luck. This is how markets work. They rotate. What's hot today becomes cold tomorrow. What's ignored today becomes the winner tomorrow. If you had abandoned international stocks because they weren't performing, you would have missed out on one of the best international stock years in recent memory. The current price of VXUS is $72.75 per share, and the fund pays an annual dividend of $2.04 per share, giving you a dividend yield of 2.81%. That's significantly higher than VTI's dividend yield, which means more passive income hitting your account every quarter. So what are you actually buying with VXUS? Let's break down the geographic exposure. 42% of the fund is invested in Asia, led by companies like Taiwan Semiconductor Manufacturing, the company that makes chips for Apple and Nvidia, and Tencent Holdings, the Chinese tech giant. 39.86% is in Europe, giving you exposure to industrial powerhouses like Nestle, ASML, and luxury brands like LVMH. Then you've got 8.5% in North America, mainly Canada, 4.77% in Oceania, including Australia, and 2.69% in the Middle East. You own the entire world's growth story, from Asian technology leaders to European industrial giants to emerging market champions. The expense ratio is just 0.05%, meaning you're paying $5 per year for every $10,000 invested. Still incredibly cheap. And here's the lesson that 2025 is teaching us loud and clear. Diversification isn't just a theory you read about in textbooks. It's your safety net when one market struggles, and it's your opportunity when another market surges. While everyone was focused exclusively on US stocks, international markets quietly set up for an incredible year. This is why you need both VTI and VXUS. Markets are unpredictable, but by owning everything, you're guaranteed to capture whatever performs well. Fund number 3, BND. Now let's talk about the unsung hero of the 3-fund portfolio. The fund that doesn't get much attention, but is absolutely critical to your success. This is BND, the Vanguard Total Bond Market ETF, and this is your portfolio's shock absorber. BND holds $139 billion in assets and gives you exposure to 17,656 different bonds. This fund is massive, diverse, and incredibly important for managing risk. Let me tell you a story about why bonds matter. In March 2020, when COVID hit and the stock market crashed, VTI dropped 35% from its peak. VXUS fell 36%. People were panicking. Portfolios were getting crushed. But you know what BND did? It only dropped 18.84%. While stocks were in free fall, bonds cushioned the blow. If you had a portfolio that was 80% stocks and 20% bonds, your total drawdown was significantly less severe than someone who was 100% stocks. More importantly, you probably didn't panic and sell at the bottom because your losses weren't as catastrophic. That's the power of bonds. They're not exciting, but they keep you in the game during the scary times. Fast forward to 2025. BND is trading at $74.21 per share. The year-to-date return is 5.9%, which might not sound impressive compared to stocks, but remember, bonds have a different job. They're not here to shoot the lights out. They're here to provide stability and income. And speaking of income, BND has a dividend yield of 3.77%, and those dividends are paid monthly. That's passive income hitting your account 12 times per year, not 4 times like VTI and VXUS. For retirees or anyone who wants regular cash flow, this is incredibly valuable. So what's actually inside BND? The fund holds 51.47% in U.S. government bonds, which are backed by the full faith and credit of the United States government. As safe as it gets, 25.56% is in corporate bonds from companies like Apple, Microsoft, and J.P. Morgan. 21.49% is in securitized debt and mortgage-backed securities. And 1.48% is in cash and other assets. The fund maintains an effective duration of 5.85 years and has an average credit rating of AA, which is very high quality. The expense ratio? Just 0.03%. $3 per year on every $10,000 invested. When stocks zig, bonds zag. That's the saying, and it's mostly true. Bonds provide ballast. They provide income. And most importantly, they provide the psychological comfort that keeps you invested during the inevitable market downturns. This is how you sleep well at night while building wealth. Now that you understand the 3 funds, let's talk about how to actually use them. Your allocation depends on one critical factor: your timeline. How long until you need this money? Let me walk you through 3 different profiles, and you can figure out where you fit. If you're a young investor in your 20s or 30s, you've got decades until retirement. Time is your biggest advantage, so you can afford to be aggressive. The recommended allocation is 60% VTI, 20% VXUS, and 20% BND. That's an 80-20 split between stocks and bonds. You're maximizing growth potential while maintaining some defensive positioning. If the market crashes 30%, yeah, it's going to hurt, but you've got 30 or 40 years to recover and then some. The bonds are there to take the edge off the volatility, but you're still heavily tilted towards stocks because that's where the long-term returns come from. Now let's say you're in your 40s or 50s, mid-career. Maybe kids are getting close to college. Retirement is on the horizon but still a ways off. You want to start dialing down the risk a bit while still maintaining growth. The recommended allocation here is 50% VTI, 20% VXUS, and 30% BND. That's a 70-30 split. You're still majority stocks, but you're giving bonds more room to stabilize your portfolio. You've accumulated significant wealth by this point, and you don't want to see it evaporate in a market crash. This allocation gives you growth with a bit more cushion. Finally, if you're 55 or older and approaching retirement, the game changes. Now you're focused on protecting what you've built while still generating growth to stay ahead of inflation. The recommended allocation is 40% VTI, 20% VXUS, and 40% BND. That's a 60-40 split. You're still invested in stocks because you need growth over a 20 or 30-year retirement, but you've got a substantial bond allocation to reduce volatility and provide income. When you're living off this money, you can't afford to have it drop 40% in a year. Here's the beautiful part about all three of these allocations. On a $100,000 portfolio, your total annual fees are just $37. 37 bucks. That's it. A typical actively managed portfolio charging 1% would cost you $1,000 per year. You're keeping an extra $963 every single year by using this simple strategy. If you made it this far, you're already ahead of 90% of investors who are still bouncing between get-rich-quick schemes. Reward yourself by hitting that like button. Subscribe to this channel because I'm building a community of smart, patient investors who understand that wealth is built in decades, not days. And here's my challenge. Comment your current portfolio allocation. Be honest. I want to see who's already doing this, who's close, and who needs to simplify. No judgment, just progress. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.